Richard entered retirement at age 62. He had set money aside prudently across 30 years. He possessed a traditional IRA valued at $600,000, and he had a definite plan for exactly how he intended to use those funds. During the following several years, while his earnings stayed minimal and his tax category remained virtually vacant, he planned to shift the largest possible sum from his traditional IRA over into a Roth account. He would settle the taxes during this low-rate period, so he would never owe them again later. He had completed thorough research. He had studied the publications. He fully grasped the approach. He carried out aggressive conversions for 2 years, totaling $180,000 across that period. He covered the taxes from a separate savings account, allowing the entire converted sum to deposit inside the Roth. His consultant confirmed he was handling every aspect correctly. Then he reached 65 and registered for Medicare. Soon the notification arrived from the Social Security Administration. His Medicare Part B premium was not the typical $22.90 a month that most retirees pay. It was $443.10 per person per month for each of them. He and his wife were spending an extra $4,112 a year for Medicare compared to the couple next door with the same current earnings. The earnings that caused this were not from employment. He had not worked for 3 years. It resulted from the Roth conversions performed at age 63 2 years earlier. Earnings on which he had already paid taxes. Earnings he believed were completed. He performed the appropriate action at an incorrect time. And this represents the experience of millions of retirees who carry out all the proper steps but in the wrong sequence and only discover the problem when the invoice arrives. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Wasim. Every week I analyze the tax regulations, the financial pitfalls, and the approaches that shield retirees from the issues nobody else is describing. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Today, I am going to guide you through precisely why the IRS and Medicare treat age 63 differently from every other age in retirement. I am going to clarify the 2-year look-back rule that almost no one comprehends until it becomes too late. I will demonstrate what this means in actual dollar figures using the confirmed 2026 numbers. And I am going to provide you with a straightforward action plan based on exactly how old you are at this moment. Whether you are 59, 62, 63, already participating in Medicare, or anywhere in between, this is not a hypothetical issue. This is occurring to actual retirees right now this year, because nobody took the time to explain how the rules modify at 63. Most individuals are aware that Medicare Part B includes a monthly premium. What most individuals do not realize is that the premium is not identical for everyone. The amount you pay depends on your income, and not your income at present, but your income from 2 years earlier. In 2026, the standard Part B premium for most retirees is $22.90 per month. That is the base rate. If your modified adjusted gross income from 2024 was at or below $109,000 for single filers or $218,000 for married couples filing jointly, you pay the standard rate. But Medicare does not stop there. If your income from 2 years ago surpassed those thresholds, Medicare adds an extra charge on top of your standard premium. This extra charge is called the Income-Related Monthly Adjustment Amount. Everyone calls it IRMA, and here is what makes your IRMA hazardous. It is not a gradual increase, it is a cliff. Cross the threshold by one single dollar, and your entire annual premium jumps immediately to the next tier. For a married couple where both spouses are on Medicare, crossing the first tier costs nearly $2,000 more per year, not because of anything you did this year, but because of income you had 2 years ago. Let me give you the exact numbers for 2026. So this is concrete. At the standard tier below $109,000 single or $218,000 joint, you pay $22.90 per person per month. Cross into the first IRMA tier from $109,000 to $136,000 single or $218,000 to $272,000 joint, and the premium jumps to $284.10 per person per month for a couple that is nearly $2,000 more per year than the standard rate. Second tier, $136,000 to $163,000, single $272,000 to $326,000 joint. The premium is $365.60 per person per month. Third tier, 163,000 ton to 195,000 single, 326,000 to 390,000 joint, $447.10 per person per month. Fourth tier, 195,000 to 500,000 single, 390,000 to 750,000 joint, $528.60 per person per month. In the top tier, above 500,000 single or above 750,000 joint, $689.90 per person per month. For a married couple in the top IRMA tier, Medicare Part B alone costs over $16,500 per year, compared to under $5,000 for the same couple below the first threshold. Same Medicare coverage, different income from 2 years ago, and every single dollar of the difference is based not on what you earn today, but on a tax return that is already filed and already passed. It is a cliff. $1 over the threshold, and you jump to the next tier immediately. The entire extra annual cost applies from January 1st of that Medicare year. You cannot appeal it simply because you went over by a small amount from a one-time event you thought was behind you. Now, here is the rule that changes everything at age 63. Most people start Medicare at 65. That is when the standard Medicare enrollment window opens. And when most retirees enroll in Part B and Part D, Medicare uses a 2-year look back to set your premiums. Your Medicare premium in a given year is based on your tax return from 2 years prior. So the premium you pay in your first year of Medicare at 65 is based on your income at 63, not 64, not 65, 63. That means if you are 63 right now, every income decision you make this year is directly setting your Medicare premium when you first enroll at 65, the IRA withdrawal you take, the Roth conversion you do, the stock you sell at a gain, the rental property income you collect, all of it lands on a tax return that Medicare will pull 2 years from now and use to calculate what you pay for coverage every month. If you are 62 right now, your income this year goes into the look-back window for age 64. That still matters because your second year of Medicare premiums at 66 will be based on your income at 64, but your first year at 65 will be based on what you earn at 63. If you are 61 right now, you still have a full planning window. Your income at 61 affects your Medicare premium at 63, which is when people start worrying about the look back. You have time to structure things correctly before the clock starts. But if you are already 63 and you have not thought about this, the decisions you make between now and December 31st of this year are among the most financially consequential of your entire retirement. Let me be very direct about something that most financial advisors and most retirement planning articles miss completely. They focus on tax brackets and Roth conversions without ever mentioning the specific age dimension. They tell you to convert while your income is low. That is correct advice. What they often forget to add is that low income at 63 still has a consequence 2 years later. Even if you pay zero income tax on the conversion itself, the tax cost and the Medicare cost are calculated separately. You can pay no income tax at all on a Roth conversion and still trigger thousands of dollars in extra Medicare premiums because the conversion pushed your modified adjusted gross income over the IRMA threshold. These are two completely separate calculations, and almost nobody explains them together. Let me walk you through 3 real situations so you can see the dollar amounts and recognize your own circumstances in one of them. David is 63 years old. He retired at 61 from a manufacturing company in Michigan after 34 years. He has a traditional IRA worth $420,000 and a small pension that covers his basic bills. He knows about Roth conversions. He has been reading about them for 2 years. His income is low. His tax bracket is nearly empty. This year, he decides to convert $120,000 from his traditional IRA to a Roth IRA. His modified adjusted gross income for the year, including the conversion, lands at $139,000. That is above the first IRMA tier threshold of $109,000 for single filers. 2 years later, David enrolls in Medicare at 65. His standard Part B premium should be $22.90 per month, but because of the lookback, his premium is $365.60 per month. That is $342.70 more per month than the standard rate over 12 months. That is $4,112.40 more per year that David pays for the exact same Medicare coverage. His neighbor with lower prior year income pays less for over his first 2 years on Medicare. Before the look-back shifts to a different income year, the IRMA surcharge cost him nearly $4,000 in extra premiums. That is money that came directly out of the Social Security check he was counting on every month. David's Roth conversion was probably the right long-term decision, but if he had done the same conversion at age 61 instead of 63, or if he had split it across 2 years to stay below the IRMA threshold, the Medicare surcharge would not have applied. Same strategy, different timing, nearly $4,000 in savings. Sandra and her husband Thomas are both 63. Sandra still works part-time and earns $48,000 a year from consulting. Thomas receives Social Security of $22,000 per year. They also sold some appreciated stock this year. Stock Sandra's father had given her decades ago. The gain on that sale was $60,000. Between Sandra's consulting income, Thomas's Social Security, the stock sale, and a small IRA distribution Thomas took because he needed some cash for home repair, their combined modified adjusted gross income for the year lands at $245,000 as a married couple filing jointly. Sandra and Thomas had no idea any of this would matter in 2 years. They were just managing their finances the way they always had. Nobody told Sandra that selling appreciated stock at 63 would set her Medicare premium 2 years later. Nobody told Thomas that the IRA withdrawal for a home repair would count. They were not making unusual financial decisions. They were just living their lives. 2 years later, they start Medicare. Their first-year Part B premium is $365, $60 per person per month. Together, they are paying an extra $3,950 per year, more than they would have paid if their income had stayed below the first tier. Over the 2 years that those premiums apply before the look-back shifts to a different income year, that is nearly $8,000 in extra Medicare costs. And the painful part is that most of the income events that triggered it were things they could have timed differently. The stock sale could have been spread across 2 years. The IRA withdrawal could have come from a taxable account instead. None of these required complicated strategies. They required knowing the rule before the decision was made, not after. Margaret is 63 years old. She's a retired nurse from Georgia. She has no IRA. She has a defined benefit pension from the hospital she worked at for 27 years, and she receives Social Security. Her combined income is $64,000 per year. She has never heard of IRMA. She does not own stocks. She has never done a Roth conversion. She pays her bills, lives modestly, and does not think about Medicare costs because she assumes they will be the same for everyone. When Margaret enrolls in Medicare at 65, she pays the standard premium. Nothing about age 63 matters in her situation because her income at 63 was below the threshold, and she had no large one-time events. Margaret is actually the majority of retirees. Most people on Social Security and modest fixed incomes never hit the IRMA threshold, and age 63 is genuinely not a critical year for them. But if you have a traditional IRA, a 401k, a taxable brokerage account with appreciated holdings, rental property, stock options from a job you left, or any source of income you can control in timing or amount, you're not Margaret. You are David or Sandra. And the decisions you make at 63 can cost you thousands of dollars per year in higher Medicare premiums for multiple years going forward. If this video is helping you understand something your financial advisor has not explained, hit the like button right now. It tells the algorithm to show this to more retirees who need to hear it. And if you're not subscribed yet, hit subscribe and turn on the bell right now. I make videos like this every single week, and you do not want to miss what is coming next. Here is what makes age 63 genuinely unique among all the ages in retirement. It is not just IRMA. It is the fact that 3 completely separate financial systems collide at this one age simultaneously, and each of them wants something different from your income. The first system is income taxes. At 63, many retirees are in what planners call the gap years. They have retired, but they have not yet started Social Security or required minimum distributions. Their income is at its lowest point in decades. This makes 63 an attractive time for Roth conversions, capital gains harvesting, and other income-generating tax strategies. The tax argument says, generate income now, because the tax rate is low and the opportunity will not last. The second system is ACA health insurance subsidies. If you retire before 65 and you need health insurance before Medicare starts, you're likely buying coverage through the ACA marketplace. ACA subsidies are based on your modified adjusted gross income. The lower your income, the more financial help you receive with your premiums. Before 65, a couple who manages their Magi carefully can sometimes save $15,000 to $25,000 per year in insurance costs compared to someone who lets their income run high. The ACA argument says keep income low because the subsidy shrinks or disappears as income rises. The third system is IRMA. Your income at 63 sets your Medicare premium at 65. The IRMA argument says keep income below the threshold to avoid the surcharge at 65 and 66. The problem is that these three systems do not want the same thing from your income at 63. I want to give you a real example of what this tension looks like in practice. Take a couple, both 63, who retired early. They have $400,000 in a traditional IRA, $200,000 in a taxable brokerage account, and $100,000 in a Roth. They are buying health insurance on the ACA marketplace before Medicare starts. If they keep their Magi at $70,000, they qualify for a significant ACA subsidy. Their health insurance costs are manageable, but at $70,000 of income, the Roth conversion they can do this year is small. They have roughly $30,000 of bracket space available before their income starts triggering additional consequences. If they push their Magi to $150,000 by doing a larger Roth conversion, they lose their ACA subsidy entirely. Their health insurance costs jump by $12,000 to $18,000 for the year, but they move $80,000 more dollars into Roth. 2 years later, that conversion income shows up in the IRMA calculation, and they pay a higher Medicare premium at 65. The short-term cost is real. The long-term benefit in reduced RMDs and tax-free Roth growth might be greater, or it might not be depending on their situation. There is no universal right answer. The answer depends on how much is in the IRA, how long they expect to live, what their tax rates will be at 73 when RMDs start, and what their income looks like going forward. But here is what is non-negotiable. You cannot make this decision correctly without understanding that all three systems are in play at 63 simultaneously. The person who gets this right is not smarter or wealthier than the person who gets it wrong. They are simply the person who knew all three rules existed before making the decision. This is why generic retirement advice, convert while your income is low, is not wrong, but is dangerously incomplete at age 63. The answer depends entirely on your specific numbers. How much is in your traditional IRA, what your current income is, how much your ACA plan costs, how long until Medicare, what your projected income looks like at 65 and beyond. These variables interact in ways that simple rules cannot capture. Let me walk you through the full timeline so you can see exactly how the 2-year look back affects each year of Medicare coverage, and why the window for action is more specific than most people realize. Your Medicare premium in 2026 is based on your income in 2024. Your Medicare premium in 2027 is based on your income in 2025. Your Medicare premium in 2028 is based on your income in 2026. The pattern continues every single year you are on Medicare. If you start Medicare in January of the year you turn 65, your first-year premium is set by your income 2 years prior when you were 63. Your second-year premium is set by your income when you were 64. Your third-year premium is set by your income at 65. This means the IRMA window does not stop at 63. It is ongoing. Every year you are on Medicare, your premium from the current year is being set by decisions you made 2 years ago. The reason 63 is uniquely important is that it is the first year that directly affects your Medicare costs. It is the starting gun. But the race continues for as long as you are on Medicare. A retiree who is 75 today and had a large required minimum distribution 2 years ago at 73 is paying IRMA charges right now in 2026 because of income they had in 2024. The look back never stops. It follows you through every year of retirement. The difference is that at 63, you still have the ability to control the income before it happens. By the time required minimum distributions begin at 73, the forced nature of those withdrawals makes the income much harder to manage below the threshold. This is also why Roth conversions done early at 60 or 61 are so powerful from an IRMA perspective. The income from those conversions is already 2 to 3 look-back cycles behind you before you even start Medicare. The surcharges simply do not reach back that far. And this is exactly why the strategic advice from every serious retirement planner is to do your heaviest Roth conversions before age 63, if at all possible. Not because 63 is the only year that matters, but because it is the first year where Medicare starts collecting the premium based on what you did. Now, let me address something that comes up every time I explain IRMA. People ask whether they can appeal if they get hit with a surcharge based on income that no longer reflects their current situation. The answer is yes, but with very specific conditions. The Social Security Administration allows what is called a life-changing event appeal. The form is SSA 44. If your income has dropped significantly in the years since the look-back year, and that drop was due to a qualifying life-changing event, you can ask Medicare to use a more recent tax year instead. Qualifying life-changing events include retirement or reduction in work, marriage, divorce or annulment, death of a spouse, loss of income from property due to a disaster or other event, loss of pension income, and employer settlement payments. What does not qualify as a life-changing event for IRMA appeal purposes is a deliberate financial decision. If you chose to do a large Roth conversion at age 63, paid the higher premium for 1 or 2 years, and your income has since returned to normal levels, Medicare will eventually recalculate your premium based on the most recent available tax return. You do not need an appeal for that. Time handles it naturally as the look-back shifts. The appeal is specifically for situations where your income dropped dramatically because of something that happened to you, not something you planned. If you genuinely had a qualifying event, you retired, you lost a pension, your spouse passed away, and your income has dropped significantly, the SSA 44 form is worth filing. You submit it with documentation of the event and your current income. The process is now available online through ssa.gov and is more accessible than it used to be. The approval rate for legitimate life-changing events is high, and most retirees who qualify have never heard of this form. There is one more dimension to this that deserves its own moment because it is the cruelest version of the trap, and almost no one warns about it in advance. When two spouses are on Medicare together and one of them passes away, the surviving spouse faces an immediate and devastating change in their calculation. While both spouses are alive and filing jointly, the IRMA thresholds are much higher. The first tier for married filing jointly starts at $218,000 in 2026. A couple can have significant combined income and still stay below the surcharge. When one spouse passes away, the surviving spouse must file as single for all future tax returns. The single filer IRMA threshold is only $109,000. The exact same income that caused no surcharge when they were filing jointly now triggers IRMA at the full single filer rate for the surviving spouse. This is called the widow penalty, and it is financially brutal. A widow or widower whose joint income was $200,000 pays no IRMA while married. The year after their spouse dies, they file as single on the same income, and their Medicare premium jumps immediately to the third tier. They did nothing different. Their income did not change. Their Medicare costs dramatically increase simply because they are now filing as single. Let me put a real number on this. A couple filing jointly with $200,000 in income pays the standard Medicare Part B premium in 2026 because they are below the $218,000 joint threshold. When one spouse passes away and the survivor files as single the following year, the same $200,000 income is now above the threshold for the third IRMA tier. The surviving spouse's monthly Part B premium jumps from $22.90 to $447.10. That is an increase of over $5,000 or $90 per year from the same income simply because they are now alone. Roth conversions done before this scenario occurs are one of the primary protections against the widow penalty. If the couple converts significant IRA assets to Roth before one spouse passes, the surviving spouse can draw on tax-free Roth accounts in the years after. This keeps their modified adjusted gross income lower as a single filer and helps them stay below or close to the IRMA threshold. This is another reason why age 63, when most couples are still together and still filing jointly, is such a critical window for Roth conversion planning. You have the higher joint threshold working in your favor right now. The day that changes, you may not be able to get it back. Here is your action checklist. What you need to do based on exactly where you are right now. If you are 60 or 61 right now, you are in the cleanest conversion window you will have. Your income at these ages is not in the IRMA look back for your first years of Medicare. You have the most flexibility for Roth conversions. Use it deliberately. Model how much you can convert each year while staying in a tax bracket you are comfortable with and convert as aggressively as you are willing to over the next 2 to 3 years. Every dollar you move to Roth now is a dollar that will never appear in an IRMA calculation for the years immediately following your Medicare enrollment. If you are 62 right now, you are 1 year away from the first critical year. Your income this year sets your Medicare premium at 64, your second year on Medicare. It is still a productive conversion year, but you should begin modeling exactly where your IRMA threshold sits and what your projected income will be at 63. The 2 years of 62 and 63 together form your initial IRMA window, and they deserve a coordinated plan, not independent decisions made 1 year at a time. If you are 63 right now, stop and do this before making any income decision for the rest of the year. Pull up your most recent tax return and find your modified adjusted gross income on line 11 of your Form 1040. Now calculate where you stand relative to the threshold for your filing status. For single filers in 2026, that is $109,000. For married filing jointly, it is $218,000. Every Roth conversion, stock sale, IRA withdrawal, or other discretionary income event this year should be sized to stay below that threshold unless you have specifically modeled the long-term Roth benefit and decided crossing it is worth the premium cost. Do not guess. Run the numbers or have someone run them for you before December 31st. This is the single most important financial deadline you have this year. If you are 64 right now, your income this year sets your second year Medicare premium at 66. The same analysis applies. This is also a year where many retirees start Social Security benefits, which adds to their taxable income and makes managing the IRMA threshold more challenging. If you're considering when to claim Social Security, the income impact at 64 on your Medicare premium at 66 is one factor worth modeling alongside everything else.